Well, there's JPMorgan. And I always say covering JPMorgan is like covering, four big companies,
Yep,
right?
yep.
Or, depending on how they've done their division, I guess it's three big companies now. So, really the net interest income guidance very strong. About 600 million upside to the core
ratios
NII.
were sick. I went back and forth with Valerie Titel in London. They did a tangible equity of 20% plus. Am I right? Citigroup's half that?
You are right. I mean, if you look at, so if you look at Citigroup, it's a very different story, right? So Citigroup is still in a story of transition. We've been talking about that transition, as we say, ever since Sandy built the house. It's been being taken apart. And I think Jane Fraser is making a lot of tough decisions there, and really solid quarter out of Citigroup as well. They're upping their net interest income guidance. Their fixed income trading up 20%. So that's JP Morgan and Wells were up 13 to 14%. Citigroup has an amazing rates and currencies trading business, as you know, Paul. And that is really where the strength is this quarter. That's where the volatility is. And they are really executing in that business. Again, core net interest income going up for both of those banks. Wells Fargo a little softer, but Wells Fargo is looking at the overall number. Keep in mind that there is core net interest income, and then there's a number that includes trading. And so the trading net interest income tends to be offset in fees. I think from a headline perspective, people are sort of going to be less positive on those Wells Fargo results. Wells Fargo also not getting this huge benefit. So as I said, they saw some growth in fixed income trading, but JP Morgan and Citi much stronger in those businesses. JP Morgan delivering $1 billion of upside in their trading and fee. I haven't done the calculation yet for Citigroup, but the trend's also better for Citi.
What are the banks saying about loan origination? Are they writing loans? We were just talking to Hugh Van Steenis and Oliver Wyman about private credit, and I just think back to my Chase Manhattan days. We were killing it doing the leveraged loan business, making money up front, making money on the spread, syndicating my risk out to every other bank around the country. What are they making loans these days?
So they are making loans. I mean, the card business, which was probably not your concern back then or now, but the card business is very profitable for these banks, and that's where the loan growth has been. And again, that's benefiting Citi and JP Morgan. We have seen a little bit of pickup in the commercial numbers in the Fed data. We're going to hear what Bank of America says tomorrow on that. I think with regard to privates, it is a change. But I think if you look at, for example, Goldman's business, so Paul, Goldman, their merchant banking business, that they, back in the day made a lot of money from making these proprietary investments. Volcker rule came along and said, please don't do that on your balance sheet. By the way, investors don't like the balance sheet, right? Because when you make those kind of investments and you're recording gains, people don't really give you a lot of credit because they view them as volatile, et cetera. But you have someone like Goldman who's now said, I'm going to be an alternative asset manager. And now instead of putting my balance sheet at risk, I'm going to take the client's money. So, and I'm going to earn fees, and investors like that. They like asset management. It's a high multiple business. And so it's a higher return on equity business. And that's been a long-term story at Goldman. So I think the banks are fine. And that's a Goldman specific, but I think all the banks are doing that.
Okay, I want to go to the gossip of the moment, folks. Out in the Hamptons over a beverage of her choice, Alison Williams is getting hammered by fancy people over the reorg under Mary Erdos at JP Morgan. First of all, I'm going to say they're the most successful bank asset manager, the only one really competing with BlackRock and the others. So Mary's built a franchise, and now they're saying geography doesn't matter anymore. The Wall Street Journal had this great summary of it. Explain to us how JP Morgan and Mary Erdos is blowing up asset management, private wealth.
Well, I think that, Mary Erdos is first and foremost thoughtful about the talent across her business and, is consistently talking about the strength they have as an active manager. But one of the more interesting things that Eric Balchunas, as you know, who's the expert on ETFs, has been talking about is that they are really gaining share in the active ETF business. And so, so that's not your question, but that is something that I want to highlight that I think is something happening over there.
We're in a bull market. They're minting more money than God. And JPMorgan is saying, we got a problem. We got to blow up private wealth management. Why are they blowing it up, and what's the goal?
Well, again, I don't know. I think that Mary Erdoes is a very thoughtful leader, and I think that, again, it's sort of like as we're going through the future, we've been through a long period of what we call U.S. exceptionalism.
Yep.
But I think that JPMorgan has always focused on the world at large, focused on emerging markets, focused on these different growth opportunities. And I think it's just a way. And by the way, JPMorgan, I think, is always, as I alluded to earlier, looking at things differently. When you're a global organization, you have products and you have regions, I think sometimes you have to find a way to focus on both. And I go back to the fact that they're very focused on talent. And I think that, that they're thoughtful about the way they run their business.